Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Neogen Corporation quarterly report. Neogen Corporation offers a wide range of products and services for food and animal safety globally. The company operates through two main segments, food safety and animal safety. The food safety segment provides various diagnostic test kits and complementary products to detect harmful substances in human food and animal feed. These include tests for pathogens, toxins, allergens, drug residues, pesticide residues, and sanitation concerns. Additionally, the segment offers software systems for analyzing and storing results, natural toxin tests, rapid sanitation tests, culture media products, filter tests, sample collection products, and laboratory services. The animal safety segment provides reagents and test kits for immunoassay production, forensic and animal toxicology, life science research, veterinary instruments, disposables, animal care products, digestive aids, nutritional supplements, rodent and insect control products, disinfectants, and genomic services such as DNA genotyping, sequencing, and trait analysis. Neogen Corporation's customers include various industries and markets, including food service, dietary supplements, companion animal veterinarians, livestock producers, retailers, breeding and genetics companies, diagnostic labs, universities, distributors, and government agencies. Neogen Corporation maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Neogen Corporation trades at a lower price-to-book ratio of 1.04 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 40% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be summarized into several key factors. Revenue growth is primarily driven by organic growth, acquisitions, and an increase in service revenues. The food safety segment has shown mixed results, with a 3% increase in the 3 months ended February 28, 2026 compared to 2025, but a decrease of 0.4% in the 9 months ended February 28, 2026 compared to 2025. Deferred revenue additions and a gain on sale of business have also contributed to revenue growth. On the other hand, revenue decline is primarily driven by foreign exchange rates, industry trends, and elevated interest rates and higher borrowing costs. The animal safety segment has been particularly affected, with a 20% decrease in the 3 months ended February 28, 2026 compared to 2025. Order fulfillment issues, lost market share, inventory write-offs, delays in restarting production inefficiencies, economic policy shifts, retaliatory tariffs, and supplier quality and manufacturing issues have all contributed to revenue decline. Overall, the company's revenue growth is driven by a combination of organic growth, acquisitions, and service revenues, while revenue decline is driven by external factors such as foreign exchange rates, industry trends, and elevated interest rates. The net income of the company has undergone a significant transformation from a loss of $479.8 million to a relatively modest loss of $24.7 million. This improvement can be attributed in part to the absence of a goodwill impairment charge of $461.4 million that was incurred in 2025. However, despite this positive trend, profit margins have been affected by various factors. The food safety segment has seen an increase in net revenue, but its operating income has decreased due to higher costs and expenses. On the other hand, the animal safety segment has experienced a decline in both net revenue and operating income, resulting from volume decreases, inventory write-offs, and duplicative costs. The decrease in gross margin is another contributing factor to the decline in profit margins. The company's inability to maintain its previous levels of efficiency and productivity has led to increased expenses, which have offset some of the gains made in terms of net income. Overall, while the company has shown improvement in its net income, it still faces challenges in maintaining healthy profit margins due to various operational and financial factors. The company's financial performance is a positive indicator of its ability to generate cash from its core operations. The data shows that the company has consistently produced operating cash flow in both 2026 and 2025. In 2026, the net cash provided by operating activities reached $53 million, while in 2025 it was $41.8 million. These figures demonstrate a strong ability to generate cash from its core operations, indicating that the company is financially stable and capable of meeting its obligations. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, the total debt decreased by 11.6% from $902.4 million to $800 million, indicating a reduction in debt obligations. However, this trend was disrupted when net cash provided by financing activities increased by $99.6 million, suggesting an increase in debt level. Regarding interest expenses, there are mixed signals. On one hand, interest expense, net decreased by $3.1 million from $17 million to $13.9 million, indicating a reduction in interest payments. Additionally, amortization of debt issuance costs decreased from $2.6 million to $1.5 million. However, on the other hand, interest expenses increased by plus $14.5 million from $0 in 2025 to $14.5 million in 2026, and also by plus $8.7 million from $54.5 million to $63.2 million. Furthermore, higher borrowing costs led to an increase in interest expenses. These conflicting signals suggest that the company's debt level and interest expenses have undergone significant changes, but the direction of these changes is not entirely clear-cut. The performance of various segments and regions within the company has been mixed over the past year. In terms of segments, food safety and animal safety have struggled, with decreases in operating income and net revenue. The food safety segment saw a significant decrease in total assets, indicating potential financial strain. On the other hand, the corporate and elimination segment performed relatively well, despite an increase in operating loss. This was offset by a decrease in interest expense. In terms of regions, both the domestic and international regions have shown stability, with only slight decreases in total revenue. The domestic region saw a more significant decline, but still maintained a substantial revenue base. Management is projecting a positive outlook for the company's growth in the food safety market, with steadily increasing rates expected in calendar year 2026. The company is also optimistic about potential future revenue growth in the animal safety segment due to partnerships and commercial teams leveraging these partnerships. However, management acknowledges that there are still challenges to be addressed, particularly in the animal safety segment, where supplier quality and manufacturing issues have had a continued impact into fiscal year 2027. To mitigate this risk, the company is managing financial risk through derivative instruments for risk management purposes only. In terms of strategy, the company is focusing on food and animal safety through various product offerings. Additionally, management plans to sell the genomics business to Zodis Inc. by the end of the first half of fiscal year 2027, subject to customary closing conditions and regulatory approvals. Overall, management's outlook suggests a focus on growth in key markets, while addressing ongoing challenges and managing risk through strategic initiatives. The company has made significant moves in its acquisitions and divestiture strategy. In terms of acquisitions, one notable example is the purchase of the 3 Million food safety business. This acquisition demonstrates the company's commitment to expanding its offerings and capabilities. On the other hand, the company has also engaged in strategic divestitures. One such instance is the sale of its genomics business. The sale was announced on March 2, 2026, and it marks a significant shift in the company's focus and priorities. The company is facing concerns about inventory buildup and potential supply chain disruptions. The data shows a significant increase in raw materials, work in process, and finished goods inventory, indicating an accumulation of stock that may not be selling quickly enough. This is further exacerbated by the elevated backlog of open orders due to shipment delays, which suggests that the company's ability to meet demand is being hindered. Moreover, the potential for supply chain disruptions looms large, with concerns about pricing increases and quality issues from third-party suppliers, logistics partners, and package delivery services. The animal safety segment has already been impacted by supplier quality and manufacturing issues, highlighting the vulnerability of the company's operations to external factors. If these issues are not addressed, they could lead to further disruptions in the supply chain, ultimately affecting the company's ability to meet customer demand and maintain profitability. That concludes the financial summary for Neogen Corporation. Feel free to comment below, and I will be happy to answer them when possible.